Hello, I'm Hickey from interest.co.nz with a special guest appearance economic update here on the December quarter CPI figures. These measure consumer price inflation in the December quarter, and they showed an increase of 0.1% in the quarter from the September quarter. That doesn't sound like much, but it pushed annual inflation up to 1.6%. It was also more than most people were expecting. In fact, most people had expected deflation in the quarter of about 0.2%, and that included the Reserve Bank. Now, the reason for the higher than expected inflation figure, it looks like some of it's come from higher tradable prices. Now, that includes international airfares and the likes, but also there are signs that inflation is building in the housing sector. Now, we all know about higher house prices, but CPI figures look at how much it costs to build a house, or to rent it, or to maintain it, or to pay the rates on it. And that shows that building cost inflation is starting to spread out from Canterbury, where of course the rebuild has pushed inflation up. Annual new house prices inflation has increased 9.5% in Canterbury in the 2013 year. Now in Auckland it was only up 2.4% for the year, but when you look at the December figures you can see that the pressure is building in Auckland, where of course the Housing Accord is looking to increase the number of houses built there. New house cost inflation rose by 1.5% in the December quarter. That's even more than we saw in Canterbury in the quarter. And the Reserve Bank has warned that it is watching for signs that Canterbury inflation in construction costs is starting to spread to the rest of the country. And that's forced some economists to look at what's happening with interest rates. Now, up until today's figures, most people were saying that the Reserve Bank would wait until March the 13th before it put up interest rates. But the mood is shifting somewhat. ANZ came out today and said it now expects or is actively calling for the Reserve Bank to hike interest rates on January the 30th. That's next Thursday. Now that would mean that New Zealand would be the first developed country to increase its interest rates in 2014. It would be the first interest rate increase in New Zealand since July 2010. You've got to remember too that that was before the Canterbury earthquake. They rose from 2.5 to 3% in the middle of 2010. And when the earthquake happened in late February 2011, the Reserve Bank almost immediately cut it back to 2.5%. And that's how long interest rates have been flat for. Now, the Reserve Bank has been warning that it will be increasing interest rates in 2014 and 2015. In fact, Governor Graham Wheeler warned in early December that he expected to put up interest rates by 2.25% by early 2016. Now, the banks have already moved to remove some of their special rates. And now, the best rates you can get for 2-year fixed rate mortgages are around about the 6.3% mark. However, that can look reasonably attractive versus the variable rates that most people are on of about 5.7%. The key question people will ask is, how much might interest rates increase in the next couple of years? Now, the Reserve Bank is saying 2 to 2.25%. And we seem to be getting closer to the time when the Reserve Bank is actually going to pull the trigger on putting up interest rates. These higher than expected inflation figures today are a key factor in that. I'm Hickey. That was a special economic update here from interest.co.nz.